What if I told you that most investors lose money not because markets crash, but because they choose the wrong time horizon? Not the wrong stock, not the wrong crypto, not even the wrong strategy, just the wrong time frame. Every day, millions of people jump into short-term trades chasing fast profits. At the same time, quiet long-term investors patiently hold assets for years, sometimes decades. Both groups believe they're using the smart strategy. But here's the mystery. If short-term trading promises fast money, why do most professional studies show that long-term investors often outperform? And if long-term investing is so powerful, why do so many people still choose short-term strategies? Today, we're not guessing. We're not using opinions. We're using real data, historical patterns, and financial behavior research to answer one simple question. Which strategy actually makes more money, long-term or short-term investing? But the answer isn't simple, because the truth is hidden inside decades of market history, psychological traps, and repeating cycles that most investors never see. And it all starts with how investing itself was born. To understand this battle, we need to go back more than 100 years. In the early 1900s, stock markets were not designed for everyday people. They were slow. Information traveled by newspapers and telegrams. Trades took days to settle. Back then, investing was naturally long-term, not because people were wise, but because speed was impossible. Then something changed. After World War II, economies exploded, companies expanded globally, middle-class wealth grew, retirement accounts became popular. Suddenly millions of ordinary people entered the stock market for the first time. This created two paths. One group saw the market as ownership, buying pieces of real businesses and holding them long-term. The other group saw the market as a casino of opportunity, buying and selling quickly to profit from price movements. And that division only intensified with technology. In the 1990s, online trading platforms appeared. In the 2000s, mobile apps arrived. By the 2010s, you could trade in seconds with zero commissions. Speed created temptation, and temptation created a dangerous idea. Why wait years to make money when I can make it today? This belief fueled the rise of short-term investing. But something unexpected happened next. Long-term investing was built on a simple principle. Businesses grow over time. Markets reward patience. This idea was popularized by legendary investors like Benjamin Graham and later Warren Buffett. They didn't chase price movement. They focused on owning strong companies and letting compound growth do the work. Their philosophy was boring, slow, unexciting, predictable. But it worked. Meanwhile, short-term investing evolved differently. It was fueled by traders who believed markets were inefficient, that prices temporarily mispriced assets and could be exploited quickly. Day trading, swing trading, momentum trading, these strategies promised speed, flexibility, and fast profits. And during bull markets, it often looked like short-term traders were winning. Screenshots of massive gains flooded the internet. Social media turned traders into celebrities. Everyone wanted fast results. This created a powerful illusion. Short-term investing looked more exciting, more intelligent, and more profitable. But markets have a habit of revealing truth slowly, and the first major test came during market crashes. During long bull markets like the 1990s tech boom or the 2010s growth era, both long-term investors and short-term traders made money. Prices kept rising. Mistakes were forgiven. Risk felt invisible. Long-term investors benefited from compounding. Their portfolios steadily grew as dividends reinvested and companies expanded. Short-term traders benefited from volatility. They could jump in and out of fast-moving stocks, sometimes earning more in weeks than others earned in years. For a while, it seemed like both strategies worked, but this created overconfidence. And overconfidence always leads to the same place. A breaking point. Every market cycle eventually turns. The dot-com crash in 2000, the financial crisis in 2008, the pandemic crash in 2020. These events exposed the hidden weakness of short-term investing. When markets fall suddenly, short-term traders face margin calls. Emotional panic selling increases. Timing mistakes multiply. Many traders exit at the worst possible moment, locking in losses. Long-term investors experience pain too. Their portfolios drop, but something different happens. They don't need to sell. They can wait. And waiting changes everything. Here's where data becomes uncomfortable. According to multiple market studies, including research by Dalbar and brokerage performance reports, The average retail trader consistently underperforms the overall market by large margins over long periods. Why? Not because they're but because short-term strategies depend heavily on perfect timing, emotional discipline, constant decision-making, high transaction frequency. And humans are terrible at all for. The breaking point isn't the crash itself. The breaking point is human behavior during the crash. Fear destroys short-term strategies faster than price declines ever could. But this is only half the story, because long-term investing also faced serious challenges. Long-term investing sounds safe, stable, proven, but here's the twist most people ignore. Long-term investors don't automatically win either. Many people hold bad companies. Many panic sell during crashes. Many stop investing when markets fall. And inflation silently erodes returns. So if both strategies have flaws, why does the data still lean toward one side? And what happens when we compare actual performance numbers, not marketing promises? In the next part, we'll uncover what real long-term returns look like over decades, why most short-term traders lose, even in good markets, how compounding quietly crushes active trading strategies, the repeating psychological pattern that traps investors every generation, and finally, which strategy truly builds more wealth when emotions, fees, taxes, and time are included. Now comes the moment most investors avoid, because this is where beliefs meet reality. When researchers started comparing long-term investors to short-term traders over extended periods, the results were uncomfortable. Let's look at the pattern that appears again and again. Broad market indexes like the S&P 500 have historically delivered around 8 to 10% average annual returns over long periods when dividends are reinvested. That means money roughly doubles every 7 to 9 years. Now compare this with the average active trader. Multiple brokerage studies show that the majority of retail traders lose money over time. Even professional fund managers struggle to consistently beat market indexes after fees and taxes. This creates a strange contradiction. Markets themselves grow steadily, but the average person participating in those markets earns far less. Why? Because the problem isn't access to investments. The problem is behavior. Short-term trading introduces more decisions, more emotions, more mistakes, and more costs. Every trade includes bid-ask, spreads, platform fees, taxes on short-term gains, timing, risk. Long-term investing reduces all of these. Less trading means lower fees. Holding longer reduces taxes. Time allows recovery from downturns. But numbers alone don't tell the full story. So let's follow the cause and effect chain. Short-term investing sounds logical. Buy low, sell high, repeat. But reality introduces friction. First problem, timing, accuracy. To outperform long-term investing, short-term traders must be right repeatedly, not once, not twice, but hundreds of times. Miss a few big market days, and returns collapse. Studies show that missing just the best 10 market days over a decade can cut total returns by more than half. And those best days usually happen during high volatility, exactly when traders are most likely to sit out. Second problem, emotional interference. Short-term trading requires constant emotional control. Fear during drops, greed during rallies, regret after losses. Neuroscience research shows that financial losses activate the same brain regions as physical pain. That means trading literally hurts, and pain leads to irrational decisions. Third problem, overtrading. More trades feel productive, but more trades usually mean more mistakes. Overtrading increases fees, taxes, and exposure to bad timing. Long-term investors avoid this trap by doing something radical, nothing. And ironically, doing nothing often produces better results. Here's the secret weapon long-term investors use that short-term traders can't easily replicate: compounding. Compounding is not linear. It starts slow, then accelerates, then becomes exponential. In the early years, gains feel small, almost boring. But over decades, compounding creates massive differences. For example, if someone invests consistently and earns an average of 9% annually, their money doesn't just grow, it multiplies itself multiple times. Short-term traders may score big wins occasionally, but consistent exponential growth beats unpredictable spikes over time. This is why many of the world's wealthiest investors emphasize time over timing. They don't try to predict daily movement. They let economic growth do the heavy lifting. But humans don't like waiting. So every generation invents new solutions to beat long-term investing. Algorithm, trading bots, signal groups, high-frequency strategies, technical indicators promising perfect entries. These tools promise control, but most fail for the same reason. They assume markets are predictable. Markets are not machines. They're emotional ecosystems driven by fear, greed, politics, and unexpected global events. When COVID hit in 2020, no indicator predicted it. When wars begin, markets react instantly. When interest rates change, entire sectors reprice overnight. Long-term investors accept uncertainty. Short-term strategies try to fight it. And fighting uncertainty usually Now let's bring this story to today. Social media has transformed investing into entertainment. Profit screenshots, viral trade ideas, turn $100 into $10,000 stories. This creates a dangerous feedback loop. People see extreme success stories. They ignore the silent majority who lost money. They believe fast profits are normal. But data shows a repeating pattern. Most viral traders disappear within a few years. Burnout, losses, emotional exhaustion. Meanwhile, long-term investors rarely go viral because slow growth isn't exciting content. But boring wealth often beats exciting losses. Another modern factor is inflation. Cash loses value every year. Short-term trading often fails to beat inflation consistently. Long-term investing historically outpaces inflation over time. So the real competition isn't just long-term versus short-term. It's growth versus stagnation, ownership versus speculation, patience versus impulse. This debate repeats every market cycle. During bull markets, short-term traders look brilliant. Everyone wants fast profits. During crashes, long-term investors survive. Traders disappear. Then markets recover. New traders arrive. The cycle begins again. It's not a knowledge problem, it's a human nature problem. We crave speed, we hate waiting, we overestimate our skills. Markets punish impatience and reward discipline. Over and over again, so which strategy makes more money? The honest answer: for most people, long-term investing wins. Not because it's perfect, not because it's risk-free, but because it aligns with human psychology, economic growth, lower costs, time-based compounding. Short-term trading can make money, but it requires professional-level discipline, risk management, and emotional control that most people don't maintain long-term. Long-term investing doesn't require perfection. It requires consistency. And consistency beats intensity. 3 clear takeaways. Here are the 3 most important lessons from this entire story. Takeaway number 1, time in the market beats timing the market. Trying to predict short-term movements is unreliable. Staying invested allows compounding to work. Takeaway number 2, behavior matters more than strategy. Fear and greed destroy returns faster than bad investments ever will. Takeaway number 3, simple systems outperform complex ones. Low-cost long-term investing often beats complicated trading setups with fewer decisions and fewer mistakes. Here's the warning most financial influencers won't tell you. Even long-term investing fails if you panic sell. The biggest enemy isn't the market. It's you, your emotions, your impatience, your fear during crashes. If you can't handle temporary losses, no strategy will save you. And here's the open-ended question every investor must answer. Are you building wealth or chasing excitement? Because those 2 goals rarely align. If this breakdown helped you understand investing at a deeper level, like this video so more people stop falling for fast money myths. Subscribe for data-driven investing content. Comment below, long-term or short-term, which strategy do you use and why? Your answer might help someone avoid their biggest financial mistake. And remember, markets reward patience. Time exposes truth. And wealth is built quietly, not loudly.